You're in your late 20s or early 30s. You live in a city or a decent suburb. You earn, say, $70,000 a year in the US or 55,000 euros in Europe. This is considered a good income. After tax, you take home roughly $4,000 a month. Now let's look at where it goes. Rent or mortgage, $1,400. Car payment or lease, $450. Insurance, fuel, maintenance, $250. Student loan or EMI, $300. Groceries and utilities, $600. Phone, subscriptions, internet, $200. Before you've enjoyed life at all, you're already at $3,200. That leaves $800, which sounds fine until life starts happening. Occasional dinners out, a short trip, clothes that match your role at work, a credit card balance that never fully disappears. By the end of the month, there's nothing left. And this is where the confusion starts. Because you're not irresponsible. You didn't mess up. You did what society quietly expects you to do once your income improves. You upgraded your lifestyle to match your salary. That's the trap. The mistake isn't spending money. The mistake is locking future income into fixed monthly commitments. Rent upgrades are permanent. Car payments are multi-year. Subscriptions quietly stack up. Credit cards smooth over the gap until they don't. A good salary gives you access to more obligations. And once those obligations exist, your salary is no longer flexible. It's pre-spent. Here's the simple math most people never slow down to look at. A $450 car payment over 5 years is $27,000. Add insurance and interest, and you're close to $35,000. That's not transportation.